All right, we're going to go ahead and get started for today. I'm Dr. Roper, and we're going to be going over Chapter 7, Financial Management in Liberate, Your Journey to Lasting Financial Independence. It's great to be here with you again. Thanks for going through all the chapters with me, and we'll go ahead and jump right in. So I love this quote by Charles Dickens. Annual income, 20 pounds. Annual expenditure, 19 and 6, result happiness. Annual income, 20 pounds. Annual expenditure, 20 pounds, ought and 6, result misery. And there's a graphic that represents this a little bit later that I'll talk about. But this is very important, right, for financial independence and for your happiness. All right, so the second choice. So in Chapter 6, we talked about the first choice, and that first choice is how you decide to earn income and how important that is. The second choice, how much will you save? The first decision you need to make is choosing your personal income engine. The second choice is deciding how much you need to save. The recommended minimum percentage to save ranges from 15% to 20%, but the more the better. Okay, that makes sense. This percentage determines how many dollars per month you save from your personal income engine. As with all things, it is your choice. Some save less, some more. If you can't afford 15% or 20% right now, do something like 5% or 10% to form a habit. Then figure out ways to increase it until you hit or exceed the recommended savings range. Remember, these are the dollar soldiers you divert from your personal income engine into your FI account. These are the dollar soldiers working for you and going directly toward your FI. Intuitively, the more dollars you contribute to your FI account, the quicker you will achieve your FI. This decision is included in the financial management chapter because it directly relates to managing your expenses. In the last chapter, we discussed the personal income engine and how it affects the amount of income you earn. In this chapter, we'll focus on controlling consumption. By reducing expenses, you have some control over the percentage you can contribute to your FI account. Suppose you feel that your current financial management plan only allows you to contribute 10% of the cash generated from your personal income engine. In that case, it is time to look for ways to reduce your expenses to get up to the 15 or 20% savings target. Do your best for now and continue striving toward your goal of 15% to 20% of your pre-tax income. All right, so there is a illustration, and I can go down here and show that to you right here, and we're going to talk about that in this paragraph. So illustrated in the adjacent bar chart are the future values of investment accounts based on varying annual contributions after 25 years, all earning 6%. Okay, just a flat rate of 6%. The annual invested amount for each of the 5 scenarios is based on a percentage of annual income. And the annual income is, in this example, is $100,000. That's what we're assuming. And the annual savings rates are 1%, 5%, 10%, 15%, and 20%. These are the annual savings rates. For example, in the far left column, 1% of $100,000 is $1,000. Therefore, after investing $1,000 every year for 25 years at 6%, the account value would equal $54,865. Compare that to the far right column, where the savings rate is 20% of $100,000. Thus, after investing $20,000 every year for 25 years at 6%, the account value would equal $1,097,290. Okay, so coming back down to this graphic here. So future investment value based on saving percentages of $100,000 annual income over 25 years at a 6% annual return. So the only thing that's changing in this scenario is the percentage that you're saving from your income. And just as it says right here, percentage of income saved annually, 1, 5, 10, 15, and 20. And the bars are representing right? After 25 years of investing that amount every year at a 6% return, how much will you have accumulated at the end of that 25 years? So we read up there, we were right around $60,000 if you save 1%. And then on the other end of the spectrum, right, if we're saving $20,000 a year, we're up over $1 million. And then if we save 5, 10, or 15% of our income based on the $100,000 annual income example, we'd have these varying amounts, right? This is intuitive. It should make sense, right? The more we save, the more we're going to have at the end of the day. And so we really want to anchor somewhere in this 15 to 20% range mentally. So we're striving for that on a regular basis. Now, like I said, we might not be able to achieve that currently. That's all right. Do something, but with the intention of looking for ways to increase that over time so that you have enough going into your investment account to provide the financial independence that you need, right? If we're putting in too little, we're never going to get there. That's at the end of the day, that's what we're getting to, right? How much you store in the barn. In the last chapter, I emphasized the importance of advanced education and or professional skills in improving your chances of getting a higher income. The higher income does you no good to advance your FI if you spend it all. Let me explain. If you make a lot of money but don't keep much, it doesn't matter how much you make because you are not putting it toward your FI. In other words, you will always have to work for money. A farmer who toils all season might be rewarded with an abundant harvest. If that farmer, however, doesn't properly store the crops, keep them from being eaten by pests, or distribute the food effectively, the harvest could dwindle in a fraction of what it originally was. The farmer's success is better represented by how much of the harvest is presented for future consumption rather than the size of the harvest itself. In the realm of personal finance, the amount of money you earn doesn't solely determine your financial well-being. It's affected by how much you keep, save, and invest for the future. High earnings can be impressive. It reflects your efforts, skills, and career success. However, if you overspend, save too little, or mismanage your finances, your impressive income can quickly get depleted. Like the farmer's harvest, the true measure of financial success is how much money is effectively kept, saved, and invested for future security and growth. Therefore, focusing on earnings alone is insufficient. Your attention must also be given to managing and preserving wealth. All right, and so we have this here, and this is from the, kind of inspired from that Charles Dickens quote at the beginning of the chapter, right? And it's called Spend Less Than You Earn. We can see over here, scenario 1 is happiness, right? We have money right here on this axis, and we have income, and our income is up here, right? And our expenses are lower than our income, and this is the potential savings we have. And in this scenario, because we have more coming in than we have going out in expenses, we're happy, right? We have security and we feel good. However, that can quickly change. If we just flip the scenario, and we can see that we made the same amount of income, right, from scenario 1 to scenario 2. However, our expenses exceed our income, right? And this right over here, we have more expenses than we have income to pay for, right? And that creates financial bondage, which results in misery, right? As Charles Dickens explains so well. Okay, we're going to stop right there and then pick it up in the next video. We'll continue on to the financial management introduction section of the book.